Okay, we're just going to do a quick talk here on where we're at in the marketplace here and what money is doing. So let's just have a quick look at this um, chart here. So this is the typical chart of the market cycle. Here's where we were at the bottom of the bear market back in March. And we go through hope, relief, optimism, enthusiasm, exhilaration, and euphoria. This is where the bull market ends. This is where the bear market ends. And I just posted something, a piece from a guy that I got from Jeff DeGraff, founder and chairman of Renaissance Macro Research. He says consumer discretionary stocks are the most sensitive to the market cycle, and right now they're giving no indication that the cycle is about to turn. Discretionary names historically deteriorate before the cycle ends. That makes them excellent contrarian proxies for the market cycle. So we're not there. Where we were was, now let's just go back one step. This is the bottom of the bear market, and this is where the retailers sell all their stock, and this is where the smart money gets in and starts buying stocks, like we did at turbo trading. We got aggressive at the bottom of the markets, both at the bottom of the bear market from the COVID, as well as the pullback at the bottom of the market just before the election. So even though you're in a big rising channel, you're still going to get these fluctuations, minor ones. This is not, I mean, we're not in a going into a bear market or anything, but you're going to get these feelings of euphoria and despair. We were up here, we were exhilaration, markets were really going, we got euphoria, and all of a sudden we got some unease. We're in unease? Are we in denial, pessimism, panic, and capitulation? I don't think we're anywhere near those levels because this isn't the bear market, so we won't get that degree of despair. But we are. So this is where the retailers are buying. Here's where the retailers are selling. This is where the professional money managers, mutual funds and such, that's where they're selling, and this is where they're buying. So what does that mean for us right now? Well, we're in this big rising channel, and until the market says it's no longer a bull trend and the market has rolled over and going the other way, we have to trade this market like this is the trend. It's going up. We trade high beta stocks, so we get big fluctuations, and especially and we've had some big moves. I mean, this was a 3% drop followed by a 1% drop, and then 3 or 2% pop, and now it's down to 0.84% here, and this is coming into the apex. So it's no doubt we're at a critical time, and so putting on swing trades has really slowed down because I need to see this hold and go. It did here. I mean, there was big despair here, popped. We took advantage of that here. Same thing, popped, took advantage of it. But until this needs to hold the 3,800, which is the 50-day moving average and the lateral support, as well as the rising channel line. If it fails these levels and starts to go down, then perhaps the story changes, 3,750 and 3,700. Below those areas, and then we're probably into a big correction. But for now, it's not saying that. 2 trillion in so these are the things you got to keep in mind. 2 trillion in stimulus, vaccine rollouts, inflation not coming back for a few years yet. The Fed's going to keep interest rates near zero for the next 2-3 years. That allows for huge buying, consumer buying, which drives the economy. Things are going to start to open up, restaurants, flights, vacations, all that stuff. There's pent-up demand. It's not like it's gone away. There's pent-up demand, and there's lots of money on the sidelines waiting to go traveling or to go, to spend on leisure goods and such. So yeah, is it painful? Sure is. We had a significant correction here, and as because we trade the high beta stocks, there's been a pretty good haircut in the. So the importance of this is that it is coming into the wedge here. We have to trade with conviction, and if this is this is where you'd be looking to buy stocks, get aggressive if it holds this level and bounces, because it's not. I don't think this is the end of the free world as we know it. I think it's just a pullback and a correction, and we're going to see this go again. Now the market. And I've said this before, the market is weaker because the long end of the bonds, the price is going up, when in actual fact what that means, and Fed Chairman Powell said buy the dip. It's not the long end of the bonds that ends a bull market. That actually shows that the market is strong and that it could and should continue. The Feds end the bull market, not the long end of the bonds. Feds end the market by tightening, and they've said they're not going to tighten for a couple of years. So this is coming into a buying opportunity. We saw that and just to carry on this same theme, we talk about this when I do my recaps, but look at this. Look at the biotechs now at 90. This is down over 50% in just a month. Down 13.8% today. Semiconductors breaking out of this narrow channel. You're holding maybe support on the 50, down 3%. Yet financials are still strong. They're up 3% today. Financials should lead the market, and it looks like they're starting to finally. The other one that's up, of course, is the Gush, 5.5%. So as much as, and this puts us into the position where of that chart that I showed, fear and greed. When we're all getting fearful that this is going to not turn out well and we need to sell everything, absolutely wrong time to do it. Now we have to respect our stops that we have in our swing trades and such, because that's a bit different. But in the point of view of just selling everything because the market's down, you're not going to make money that way. You need to be able to take the emotion out of the trade and trade it based on the chart patterns and where we are in the economic cycle.